come back to this in just a second. But let's talk about support and resistance. The things that we want to consider. What I've done is created a basic summary, and if you follow these simple rules, they'll keep you out of trouble most of the time, and you'll pretty much know what you're doing. I was going to post a video. Yeah, the Shadow Traders Tech Support didn't like my video, so I just created a PDF. For those people who want the Balanced Trader PDF, you can just email me at Melanie Sun Trades, and I'll just email it to you. Don't email Shadow Support. You're driving bonkers. They hate it when I do that. Just email me, Melanie Sun Trades. I'm sending it to you right now at gmail.com. It's my personal email. Look in your little inbox on the go-to thing there, and you'll see my email there. Send it to me, and I will send you a copy of the PDF that I created. I revised it and created a nice Balanced Trader PDF, and we will revise it before the end of the month. So let's get going here. If you follow these rules for support and resistance, I'm going to cover several areas. You will stay out of trouble and pretty much get your timing down a lot better with regards to the counter trend strategy and the trend strategy. Now, things to consider. What we're going to be looking at today is we're going to talk about support and resistance, not just in pivots. Most people think of support and resistance, they just think of pivots. But we're also going to cover moving averages. We're going to talk about higher time frame moving averages in addition to the 1 minute moving averages. Everybody always just thinks about the 1 minute, but I want you to consider higher time frame moving averages in conjunction with the 1 minute moving averages when it comes to support and resistance information. And we're also going to be looking at short-term trend lines like, of course, our HMA color change and especially the Linreg 9. These two indicators, out of all the short-term trend lines that you could possibly use, are two really good indicators for support and resistance information to help you with your timing. And then we're also going to briefly cover fractals. So we've got a lot to get through. So let's start with, so in each section, I have a couple of rules, very summarized basic rules that if you just obey these rules, like I said, it will keep you out of trouble. So the first thing you need to know with regards to pivots is this. When going long, pivots change their properties from resistance to support when the lowest part of the candle, wick or body, clears the line by 2 ticks, and it's the reverse going short. So let's take a look at that. So that's the first golden rule that you need to apply when it comes to support and resistance. So let's look at here. Here's a good example. And I'm just going to use the currency, the Canada market today. But let's take a look at this example here. As you can see, we're trying to get through the red pivot and the green pivot over here at 10:45. And as you can see here, the green pivot's at 95.94 and the price is at 95.95. Has the lowest part of the candle cleared the line by 2 ticks? And it can be the tail, the wick, or the body, whichever is the lowest point of the candle. Because if you're going long, you have to clear the border from the lowest point of the candle. A lot of people get this confused. They always look at the highest point of the candle. They're always looking at the top. And then they jump in on a candle like this only to be whipsawed in the market. So you want to be careful. This rule is very, very important. So as you can see, the lowest point of the candle is at 95.95. The pivot is sitting at 95.94. It has not cleared by 2 ticks. When we come over to this bar over here, now we're at 95.96. And you can see that the market is free to take off. Notice that they came in with momentum, they lost momentum, and only at that point is it important to notice that the market is clear to go on to the next level, the next pivot. Will this list be available to us? You can just email me, guys. If you want a copy of my list, just email. But I'll put it up, and you guys, for those of you recording this, you can take a snapshot of the screen so you can have it right away. Is it as important on the higher time frames? Well, it's hard to judge on the higher time frames because the body of the candle is so big, right? So it's hard to judge on the higher time frames. So it's much easier to follow this rule on your medium term and your short term. So it's really more applicable on the 1 minute. If you want to get it down to a science, the best view of penetration is the 1 minute view when it comes to, especially when it comes to pivots. So, and the same will be coming short. It must clear from the high of the bar coming short. So let's find a point where we're coming down in the market. Let me give you a nice example. This is off peak time. Here's a nice example. I don't know if this is a good one, but still. 88, 95, 88. Wow. So you can see here, can you see how the market, see in this case we have the 200 moving average as well, but you can see coming short how the market can really hang up on a pivot. It'll come down, it'll pull back, it will come down, it will go sideways, it will flatten out. Only once the candle clears that pivot, the highest point of the candle is cleared more than 2 ticks from the pivot, then is the market free to go lower to the next level. So you want to remember that rule. That's the #1 golden rule. And remember that, let's take a look at this over here. Let's look at these two scenarios. Here, the market has cleared below the pivot. Up until this point, the pivot over here was support. So the turquoise pivot, up until all this time here, the pivot remained as support. It's the floor. So the market has to come in with momentum, more momentum to push through. It only has penetrated, it's considered penetration, once we break that 2-tick window from the high of the bar, wick or body. Now, the property of the pivot changes. From support, it's now the ceiling. It becomes the ceiling, and it's now resistance. So that's important because now when the market changes direction and you're trading upwards, as you can see here, all this time here, we now have to consider that the pivot is no longer support, but it is now changed to resistance. And so we have to apply the rule going along. So we have to say, well, we can't enter over here. No entry is allowed until the low of the candle has cleared by 2 ticks. Okay, the low of the candle is cleared north of the pivot by 2 ticks. So you must remember that pivots change their properties based on, are we north of the border or south of the border by 2 ticks. Every time I play a bounce of the S4, it's rare. It's the rare time, and it plows right through it. Any advice? Well, here's the thing about the S4. Okay, you gotta. Well, I'll come to that in just a second. Let me talk about just a second. We'll come to that rule. Okay, so that's the most basic rule when it comes to support and resistance. It's always 2 ticks from the low to the high is considered penetration, and the property changes from support to resistance and vice versa. Now, the next point, which will answer your question, the PP, the S3, the S4 are stronger than other pivots as barriers and require the 13 EMA to cross it before penetration will hold true. The rest of the pivots only need momentum at the beginning of a move. So if we look at our pivots, let's go to the end here so we can see the labels. Okay, We look at all our pivots, think of them, I always like this analogy, think of them as floors in the apartment building. The floors in the apartment building. And so with your pivots, you have to remember that certain pivots, have you noticed that the price just plows through them like a hot knife through butter, doesn't even see it. And yet some pivots, it stops on a dime. And just when you think it's going to go through, it doesn't. It turns around in the opposite direction. So we have to remember which ones are stronger in terms of levels. So I use this analogy. Think of all the pivots as floors in the apartment building, but think of them as wooden floors, with the exception of 3 pivots. And it's very easy to remember which 3. It's the bottom 2 and the red one. The red one is the PP. Okay, the red one is PP. And notice that's always sitting right on top of another pivot usually. So think of it as a double floor. So that is a concrete floor, and you have to wait for the 13 to cross it before it considers penetration. And the other 2 is the bottom 2, the S3 and the S4. Because why? Fear drives the market harder and faster than greed. And you have to remember how the market works. When the market reacts to, let's say, Bernanke speaks, right? Suddenly there's a sell-off, there's a panic. And then what happens is the robots, the order trading systems, their coding system kick in to start shorting. So they go lower, which then fuels the panic even more. So people who are thinking, how low does it go? Do I need to bail from my positions? They start bailing. And the more they start bailing, the more the robots start shorting. So it fuels, it's like a runaway train. And that's what happens when we have crashes, these flash crashes, okay? They're literally runaway trains. And we've seen this with these big order trading companies that don't have stops and stuff. It can run away. And so what happens is while the market is free falling or dropping like a rock due to this panic that's come in, when we hit the S3, the brakes come on. And also the S4, the brakes come on. And the people who put the brakes on, it's an organization called the Plunge Protection Team. They come in and they start buying. They start pushing money in the market to control the crashes, to prevent a complete total collapse of the market. Ever since 1929, when the stock market crashed, this organization was formed, and that's what they do. They come in, they start buying, and they usually will come and start buying here at the S3, and you'll notice that the market will stop here and turn right around some days, and other days they'll turn it right here and turn it around, and some days they'll allow it to go below and then turn it around. They will allow for a certain amount of correction, especially on Fridays and things like that. So let me show you those 2 areas, a couple of examples. Okay. Okay, here's a good example. So here we go. We're coming down, coming down, coming down, coming down. We hit a great pivot, and bang, immediately they turn the market back around. And notice that we do not go low. We stay up pretty much for the most of the morning and the rest of the day, and go all the way about the R4. So this is a common breaking point in market, the S3, and we never went lower than that for the rest of the day. So that is a stop in the market. And you notice here, look how they barely squeezed through the S3. They never wanted to go lower at the point. Again, when the markets tried to go below, came in with buckets of money and drove it on this particular day. So you want to watch for that. You want to watch for that. Now, the key thing is you want to make sure that you never, ever enter a candle like this thinking that you got a nice trend short. What is the rule that I always say? Let's see who's been paying attention. What is the rule that I always say when you enter candles on pivots? Let's see. They bounce? No. What is the rule that I always say when you enter a candle on pivot? Good, 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 good. So here's the rule of thumb, especially when it comes to the two concrete floors. You must train your eye to look for the 13 EMA in relation to the pivot that the candle is on. So if you're concentrating on this bar and you see and you locate the 13, you train your eye to always look at the 13 in relation to the barrier. And this is true for all barriers. If you want to know if price action is going to go through it or price action is going to stop and reverse on you and you're going to get caught in a whipsaw, always locate the 13 EMA first. If you see that the 13 is too far, it's going to bounce. Absolutely. That would then instead you're looking to go in the opposite direction, do a nice counter trend strategy. As you can see, this is a nice counter trend opportunity as opposed to a trend. So let's take a look at another example. Let's find one on the S4. I think we were on the S4 over here. Sorry, just trying to. Thought I had the. Okay, again. Here. As you can see here, the price will go through a concrete floor as long as the 13 moving average is about to cross it. If you think the 13 is going to cross it, then chances are you can take a candle and ride it down lower. So the rule of thumb is when it's to concrete floors, S4s, S3s, and the PP. Let me find an example with the PP for you. That's a news item, so that doesn't count. Here's a good example. Notice that the candles are going up to PP, turn right back around. So if you were considering entering on this candle here, it would be a big mistake. Even though it's got momentum, even though it's a nice big juicy bar, even though your HMA is green, even though you've got 3 moving averages back in your direction. You see, you have all the ingredients for a nice trend trade criteria. We look at our rules. What is the trend trade criteria? Enter on the touching candle. 13 EMA has 15 more degrees, 3 or more moving averages back in the direction. So you've got all the ingredients there for a nice trend trade criteria. However, when it comes to the pivots, support and resistance information, if you do not know the rules of support and resistance, you will get faked out. And if we can see here, look at the 13. Does the 13 look like it's about to cross that PP pivot, the red pivot? No. So we come and look over here. They tried again, and notice that they almost crossed. And look how we flattened out here. Completely flat. But not until the 13 actually takes on the trajectory that it needs to become a trend. The trajectory, the angle needs to be above 15 degrees or more. And the 13 actually crosses that. Now the trend is free to take off. Okay, so very, very important. You must wait for the 13 to cross. Does this apply to all pivots or just the PP, the S3, and the S4? Well, I'll tell you where it does. The rule of the crossing of the EMA mostly applies to the PP, the S3, and the S4. With regards to the other pivots, whoops, you guys can still hear me, right? Kind of weird. My internet, it's the first time that's happened. Okay, good. With regards to the rest of the pivots, let me show you some other examples. Okay, here's a good example. Can you see when you see these wooden floors, the brown one, the yellow one, the green one, the blue one, these wooden floors, the 13, if the 13's close to it, it's going to go through regardless. But notice that the price, especially if it's a strong trend, the price just runs ahead, goes through it anyway, and the 13 catches up after. So when it comes to wooden floors, you don't need the 13 to necessarily be there to cross it. Notice that the price went all the way through to this pivot up here, and the 13 never even made it through the green pivot. So the rule for the rest of the floors, the wooden floors, is you only need momentum and the direction of the trend. And even on the count of the trend, look, you don't need the 13 EMA, the price is going to go through it on the counter trend. Okay, so when it comes to wooden floors, all it requires is momentum to get through the pivots, just momentum. Okay, however, the only time that you need to be concerned when it comes to the wooden floors, that means all the other colors except for the red one, the gray one, and the turquoise one, the PP, S3, and S4, the bottom two. It's the only time you are concerned about a wooden floor where it'll stop on the dime is when it's at the end of the party or it's a flat market. Those are the only two conditions that will stop on a regular pivot. It's if it's at the end of the party or it's a flat market. See, the market's going sideways, it's not going to go through. So if it's a flat market or the end of trend, end of a big run. And as you can see here, the market never really penetrated this yellow pivot, even though we had momentum. Why? Because look at your moving averages, they're completely flat. They're going sideways, emerging into a fist. Only once the moving averages took on trajectory to go short did the momentum really come in, and we started to just penetrate the pivots again without the involvement of the 13. So let's just take a look at that and revise that point again so that you're all clear. When it comes to the red pivot, the turquoise pivot, and the gray pivot, you must wait until the 13 looks like it's going to cross it, the 13 EMA, before you enter your trade. Because those are concrete floors, they are stronger barriers compared to the other pivots. All the other pivots, which I call the wooden floors, all the other colors, the only thing you need is primarily the direction of the trend, and as long as there's momentum. Now, when it comes to the other pivots, you want to be careful if it's the end of the party and momentum disappears. You can see there we have momentum. Now we have no momentum. And also if it's a flat market. Wait for the trajectory to kick in or across, wait for the 13 to cross the pivot, and then you start trading. Is that clear? Is there anybody who has any questions on these 2 points before we move on? Do institutional traders use the same exact pivots? They do have some pivots. I mean, these pivots are uniquely coded by shadow traders. So you are getting a few extra pivots than most people have out there. How exactly should I enter on a counter trend trade off a pivot? Don't you just park an order? Yes, well, that's a good question. Let's say this is a good example right here. The question is, how do I enter a counter trend trade off a pivot? Let me just get rid of all these. And you'll notice, oh, well, I'll take this opportunity to revise the two strategies really quickly for you. So if we look at this, let's move this over here. Okay, so here we have our classic trend trade and counter trend trade in relation to the pivots. So here's our classic trend trade bouncing off the 13 EMA. going with majority of the moving averages. And here's our classic counter trend trade, bouncing off the pivot, okay, going with the direction of the HMA and your linear regressions, your short-term trend lines. So if we look at the counter trend trade, the first thing you want to look for is the circle with a dot that appears. So if you look at this asterisk, this was a circle with a dot first, and where the asterisks are, that's where your fractal is. And we'll come to fractals in just a second. But if you notice, when the circle with the dot appears and your brown Linreg, which is the one you use mostly for counter trends, the brown Linreg, when that makes a sharp V like Mount Everest, okay, you want to wait for that. That gives you an early start to the counter trend. Now, if you want to wait for your HMA to change in color, you can also do that too. That's going to give you a slightly later start. But ideally, you will see, as long as you get the V, the circle with the dot appears, or additionally your HMA to change color, then you know it's time to bounce off that pivot. Because you can see that we've lost momentum. There's momentum. Now we've lost momentum. There's no momentum. So you'll hear Barbara in the chat room. She'll say we have momentum divergence, meaning we've lost momentum and we have enough divergence between the high of the bar and the 13. The 13 is considered your next barrier. So there's enough spread there to get you 5 ticks. And if you're looking to scalp 3 ticks inside of a 5 tick spread, then you are looking for the circle with the dot and the Linreg to turn, plus your HMA if you want to be even more cautious, or if you want to get in a little early, you don't need the HMA, you can just do it off the Linreg. That's where you would enter, and you would know that that support, that pivot is going to hold as a very strong resistance point. That's what that's telling you. Because all this time you can see they plowed through this pivot, they plowed through this pivot, they plowed through the previous close of yesterday, they plowed through the previous high, they plowed, and at some point things have to run out of steam. It doesn't go up forever. At some point they have to run out of steam and give you a nice gap trade. And if you look at your next time frame higher, I like these ones because you'll find that there's another time frame. On the currencies, I like to use the 3-minute. On volatile markets, I like to use the 5-minute. But if you'll find, if you go back to 850, what's on the 17th? You will find that another time frame will confirm that move. See, if you notice, let's compare this here. I only do counter trends when the 3-minute gets involved. If we look at this run up here, notice that we had a little bit of red at 840. We had a little bit of red just after 835. And if you look at the 3-minute chart, the 3-minute chart says, no, we're not interested in going short yet. We're still long. So whenever I'm wanting to know if the trend is really over, I always make sure that my 3-minute is now involved. And notice that it gave you the circle with a dot of the same pivot, and it turned, and at that point, I am now interested in this counter trend. So I only do bounces of pivots that I know the 3-minute is also going to turn. I like this approach, showing the checklist at the same time as examples going more slowly. Exactly. Very good. Okay, so everybody clear on that? Now let's look at because we just looked at the counter trend while we're at it, let's look at the trend really quickly so that you guys are sticking to your strategies. Because remember what I say, no matter what indicators you use, you must make sure that you follow the criteria of the strategies of shadow traders. And we actually only give you 3 strategies to really focus on. One is the clear trade, the trend trade, one is the gap trade, and then one is the reversal trade, which we'll come to a little bit later. So when we're in directions. So let's look at the trend trade really quickly because we're already at this point. So on the trend trade, you must enter on the touching candle or the very next bar. So this candle is touching or this bar here, the very latest. Very latest. If you go beyond that, you could get caught in some whipsaw. So, and you may also take a candle like this where it's as close to as possible if you're sure that the trend is going higher. So I will sometimes take a trade where it's close to, it's not quite touching, because the trend is so strong. The trajectory has to be really strong for me to take a trade like that. But make sure that if you are going to do that, it's always within the two main moves of a trend. Every trend, or I should say mini trend, every mini trend has two really good opportunities, maybe a third, but after that it's a hit and miss. So never, rather look for the counter trend if you pass the first two big moves. So what we're looking for is the touching candle, very next bar. We want to make sure that our 13 EMA has 15 degrees or more. That's the little trajectory box at the top here. There must be 3 or more moving averages back in the direction of the 13. That includes the 13. So here we have the 13, we have the 100, we have the 200, we have the 50, and we have the 20. So we have all 5. If we have all 5, that's a really strong trend. And they don't all have to have trajectory. As long as the 13 has crossed it, then you know we're in for a long ride. And if you have 2 or more time frames in sync, which I call matchy-matchy, then you know that the probability is very high for that direction. So if we look at our 3-minute chart here, you can see that our 3-minute matches our 1-minute. Our MACDs match, our STOs match. We have, literally, they look like the same photograph. Here you can see that we have all the moving averages back in the direction. We have the MACD going through the center line. We have the STOs all going very nicely. The fact that this is matching this tells me when I go for this candle, I'm in for a nice one. That's what that tells me. It tells me that there's strong agreement in the market. Majority of people are trading in that direction. That's what multiple time frames mean. And now you can keep adding more time frames. You can have just 2, a 1 and a 3 or a 1 and a 5. And if you add a third time frame and you go to that opportunity as well, you will see that if we go back to the 17th at 850, you will see that it looks the same. Got the majority of the moving averages back in the direction, MACD's going through the center line. It looks pretty much the same. So that tells you there's strong agreement in that market. So everybody following along, right? So let's continue. Now, please, in last point I want to make here, ignore the wooden floors in terms of pivots when you're trading the trend. When you're trading the trend strategy, you ignore the wooden floors. The only ones you pay attention to are the red, the gray, and the turquoise. You ignore the rest of the colors if you're trading on the trend, because the fact that you have majority of the moving averages and you have the time frames matching tells you there's so much agreement in the market to go in that direction that it's going to cut through them like a hot knife through butter. So please do not miss out on an opportunity just because you see a level there. It's the beginning of a move. Imagine just every time you see this touching candle and you see this setup where it's matchy-matchy, you got your moving averages back in your direction, you see a touching candle like that, you can ignore those pivots, because I want you to imagine that you're at the Olympics and it's the 100-meter sprint and it's the Olympic runners and the gun just went off. There is so much energy at the start of the race that it ain't going to even see the hurdles. The guys are going to fly right through the hurdles and go all the way to the finish line. Once we get to the finish line, then we've lost our energy. Then that is the time you should be paying attention to the pivots. Only once things have gone for a while. Never at the beginning of the move do you concern yourself with wooden floors. Is that clear? If you've learned nothing else today, if you learn that one rule, I assure you it will help you to make better choices. Is there anybody who doesn't know that point? Okay, moving on. So we all know about the PP S3 S4 and the wooden floors, and what's the difference. Now, the same two-tick rule that we just talked about, because remember, pivots change their properties from support to resistance, resistance to support, when the lower the higher the bar has cleared by 2 ticks. But also, the same two-tick rule applies to moving averages. When doing your clear trades, applies to moving averages. So before I come to this point, let's take a look at this. Let me find a nice example on this. Well, I suppose I could use this one. Okay, can you see here that we have a candle that's pushing through the 50 moving average? It's the momentum's coming in, they're trying to get below the moving average, right? Do you notice that on this bar, we only went down to 96.13, the moving average is sitting at 96.14, and we lost momentum. Even though we went down another tick here, we lost momentum. Okay, so because we never really cleared by the 2 ticks, we lost momentum. We were really not able to continue lower. We really hugged and stayed with that 50 moving average. Only here, when momentum starts to come in, we now officially have really cleared that 50 moving average by 2 ticks, do we start to go lower. But now we have the same problem with the 100 moving average. Now, this is an off-peak time. This is 7-something in the morning. So let me see if I can find a more peak time where there's more volume in the market. So you can see volume a little bit better. You're going to see lots more dojis and less volume, and that's going to hang up more on those moving averages in off-peak times. And whenever you see your moving averages clustered, don't even trade. You must wait for a little bit divergence. So rather wait for things to the ball rolling, wait for that divergence trajectory to come in before you start trading. Just trying to find a good example here. Okay, so let's see, we can look at, here you can see, obviously we know about the 200 is a really good example for the 2-tick rule. You can see here that the 200 moving average over here, okay, the wicks of these candles are at 86 and the moving average is at 87. We never clear 2 ticks. Notice how the price action just gets really choppy. It hugs the 200 moving average like a magnet. It sticks to it. So you got to remember that the 200 moving average is the strongest moving average out of all moving averages. It's the strongest barrier. In the world of moving averages, the 200 is your concrete floor. That's why it's the color red. The other colors are, you know, as long as momentum is there and they cross each other, then things are going to continue. That's all you need to know. But here, when it comes to the 200, you absolutely must obey the 2-tick rule. So you can see here the price dropped, but the wicks of the candles really held to the 2-tick rule. They were only dropped by 1 tick. And similarly, the 13 just barely crossed it, and then things just turned right back around. And once we cleared the 2-tick rule, was price free to take off. Same here with the 50 moving average. Can you see, even though we had momentum in that bar, we never cleared the 50 moving average. We just went sideways. Only once the 50 moving average is at 95.90, once we got to this bar at 91, that didn't even really take off until 92. But then we're on the pivot. So then we had to get through the pivot. So things were not really clear until over here at 96, and then you see the price was really free to go higher, higher, higher. The price action really had a lot of problems getting through the section, very choppy because of the two-tick rule. Here we only cleared the 200, then we had to get through the 50. We never cleared until this bar, then we were on the pivot, and so on. So when trading in, especially when your moving averages are in a cluster like this, rather only start trading here where my circle it is and choose this opportunity. Just leave out this opportunity as not a good choice. Remember, especially when you're looking at two or more markets, there's going to be plenty of opportunity to trade. You don't have to take everything. Are the Word Doctor using the members download? No, you can email me if you want a copy of them. So the two-tick rule applies to all moving averages. If you want to really consider that something is penetrated, you must obey the two-tick rule, except when doing clear trade entries off the 13 EMA, because you have to get in on the touching candle, the two-tick rule does not apply as long as the 13 EMA has crossed the 20 SMA. The two-tick rule does not apply to the 13 EMA when doing trades. Okay, it does apply when doing counter trend trades. So here's a trend trade. The rule of the trend trade is you must get in as close to the bat. As the ball is leaving the bat, that's when you want to get in. So you don't get caught in whipsaw. You don't want to be waiting and waiting and waiting and getting up here when things are about to come back down. This is not the place to be getting in. Sorry. This is not the place to be getting in your trend trade. Okay? So the two-tick rule does not apply to the 13 EMA on trend trades. The goal of the trend is to get in as close to the 13 as possible to avoid whipsaw. That is the goal of the trend strategy. Now, when it comes to the counter trend trade, you want to avoid the 13 at all costs. Okay? Your exit point, remember, we always say you must have 5 or more ticks in divergence between the entry and the 13 EMA. The 13 EMA is always your exit point. It's always your exit point. In the trend trade, the 13 EMA is your entry point. What about those head fakes at 905 and 910? Well, you have to remember that this is when your moving averages are in a cluster. Okay? And when we talk about fist, we call that fist. When the moving averages are in a fist, you want to avoid trading. You want to be as late to the entry as possible. So you want to wait rather until they start to separate and take on trajectory. So even if you enter somewhere here, when you start to see the spread, the trajectory, know that you're going for quite a ride because it is a significant trend. On the counter trend, you always want to avoid the 13 EMA. So you want trading going to the 13 EMA. Now, a lot of people get confused about the two-tick rule. You know, again, when we talk about the touching candle on the 13 EMA, let's talk about this for a second here. Actually, let me find one that whipsaws so you can really see what I'm talking about. Oh, here's a classic. Here's a classic. Okay, I get this question a lot. Okay, here is your 13 EMA. So, and you will hear Barbara talk about the trend is now starting because we have the MACD crossing at the same time, and everything's at the bottom, and the stows are at the bottom, and we're looking to start in the new direction. This is actually your reversal strategy. We're reversing direction. So a lot of people say to me, but that's a touching candle on the 13 EMA. Yes, it is a touching candle. However, what is the one thing that we have to look for? It's not just touching candle to be considered a trend trade. Right now, which strategy is this candle falling in? So in terms of a criteria, which strategy does this candle fall under? How do you, it's a gap close, because remember, whenever we're looking at the price action, we are always looking at what criteria does my candle fall into. Is it my gap trade strategy? Is it my trend trade strategy? Or is it my reversal? Now, gap reversal is really a marriage between the gap and the trend, because the gap comes first and then the trend develops after. So what we're doing is we're trading that direction. However, the timing of your reversal trades can be a bit of a problem, because you fall into this rule-breaking area in terms of support and resistance. This is where support and resistance is really important. So if you're going to enter the reversal on the gap trade portion, on the counter trend portion, remember the rule of the counter trend is your 13 EMA is the exit point. So that's not really advisable to get in there. Notice that the rule for counter trend versus trend is simply this. All you have to do is ask yourself, has the 13 EMA crossed the 20 SMA? That's all you need to look for. If the 13 EMA and the 20 has not crossed, then you are in a counter trend. From the point up to this cross, it's all gap trade, and the gap trade rules apply. From the point after the cross, it's all trend trade, and the trend trade rules apply. That's what you need to know. So when it comes to support and resistance, okay, the 2-tick rule does not apply to clear trade entries of the 13 EMA, okay, as long as the 13 EMA has crossed the 20 SMA. Very important detail. Okay, you must know what is the counter trend versus the trend, and it's all about has the 1320 crossed, because this touching candle is not on the trend. This touching candle is on the counter trend, and it will whipsaw on you. And even though this is on the cross, it can still whipsaw on you. Why? Why can it still whipsaw on you even though the cross is happening? Who can tell me? Why do the HFTs come here and whipsaw the heck out of you over here? Good! Vicky gets a cookie. Sylvia gets a cookie. Maria gets a cookie. 5 ticks divergence? No. 100, 200, 200 cross? No. Okay, so all those who said support of 3 moving averages, you get a cookie. Because let me just move along and show you this. The definition of a trend is simply this. Oops, where's my document? What's the definition of a trend? Let's take a look at this more closely. Remember, these rules have to be applied religiously. The definition of the trend is simply this: 3 moving averages back in the direction of the 13 EMA. So it must be the 13 crossing the 20 SMA. You know that your trend is developing. But your trend doesn't really become a trend until it's crossed a 3rd moving average. Most of the time, it will be a 50. But it can be another color. It doesn't always have to be the 50. It can be the 100. It could be the 200. So a trend is not a trend until it has the 3rd moving average. And so you can always expect heat until you've crossed that 50. then you will see now we have enough fishies to swim in the direction. I like my fishy analogy when it comes to moving averages, because you always got to think that these moving averages are not just pretty colored lines. They actually they're averages. They represent trades. They represent fishies. Okay, so if you think of your 13 moving average as your 13 fishies swimming upstream or downstream, your black one, your 20, represents 20 fishies, and your magenta is 50 fishies, your blue one is 100 fishies, and your red one is 200 fishies. So count the fishies. If you've crossed the 20, now you've only got 33 fishies swimming in your direction. You could still bounce around because you got 50 that are swimming downstream in front of you. Now, as soon as we cross the magenta, now we have 83 fishies swimming upstream. Might we have a much easier time? Less whipsaw. So count the fishies if you're concerned about the whipsaw, and only trade with majority of the fishies. Very, very simple. Simple mathematics, okay? And you will avoid this kind of HFT stuff. So in this particular opportunity, I would simply just be going for the gap, and I would simply just be going for the trend. This is the only two places I would really be thinking about trading. Okay, and now let me talk about let me just go over one more thing when it comes to moving averages here. So we talked about the 200. The 200 SMA is your strongest barrier. You must never, oh yes, never enter a candle on the 200 SMA unless the 13 EMA is crossing it, with the confirmation of the higher time frames. So let me just confirm that one more time for you, because everybody makes this mistake. Every single person I know makes this mistake. Okay, this is a huge big problem for traders. You never, ever, ever want to enter a candle on the 200. Okay, I don't care that it's shut up there. You never enter. It will always whipsaw on you. Always whipsaw on you. You want to wait till the 13 EMA is crossing it. That's the rule for all strong barriers. And remember, what are your strong barriers? Your 200 SMA, your PP pivot, your S3 pivot, and your S4. Those are your concrete floors. Always remember your concrete floors versus your wooden floors. Your wooden floors only require momentum. Your concrete floors require the cross of the 13 EMA. Now, if you want to look at another time frame, now I think I had prepared something. Let me see if I've got the right examples to show you. Okay, so let's actually look at the 5 minute for a second here. Well, the 3 minute will probably give us a better view of this example that I want to show you. Okay, here's a good example. I want to really make a distinction for you. So pay attention to this. This is very important. When it comes to the 200 moving average, obviously we always look at the 13 crossing it, right? But additionally, if you really want to be sure that the market is going to go through the 200, because sometimes it literally stops on a dime and completely changes back the other way. So it's the battleground between the bulls and the bears, and sometimes the other side doesn't win. So what do you look for to know who's going to win the battle of the bulls and the bears at the 200? Because the 200 is your battleground. You want to look for the confirmation of higher time frame, okay? And pay attention to the bounces off moving averages across all time frames. So you can see here, if we look at this 430 time frame here, if we have a second time frame up, you will notice, what do you see? The price has run into its moving averages on the 3 minute chart. and we haven't cleared by the 2 ticks. So when people ask me, does the 2 tick rule apply? Well, it does apply to the other time frames. It's a little fuzzy in terms of seeing it within the bar, which is why we use a 1-minute chart. But know that you're going to have a problem at the 200, especially if you see the price is running into some moving averages across multiple time frames. So you can look at a 3-minute, you can look at a 5-minute, and even a 50-minute. If you see a moving average there, it's going to show you here it's the 100 moving average at 430 that we're bouncing off. We haven't cleared it. Look how far the 13 is from the 100. Only once the 13 gets a little closer to the 100, as you can see from that point, from 430, once we get the momentum in here, you'll notice that it's plotting the same resistance level as 200. Notice here we cross, and now we're clear of the border and we're able to continue higher. I thought the 200 was only on the 1-minute time frame. Yes, it is only on the 1-minute time frame. For all those people who don't know this rule, the 200 moving average is strictly a 1-minute chart indicator because it doesn't plot correctly on the other time frame. It's actually also a daily chart indicator. You can use it on your daily charts and your 1-minute charts. All other time frames we only use 4 moving averages. So if you're using a 15-minute, a 5-minute, a 60-minute, we only use 4. Where do you see the 200 on my 3-minute chart? This is my 1-minute chart. Look. Here's my 1-minute chart. Here's my 3-minute chart. I'm using the 200, but what I'm showing you is that the same resistance level is demonstrated on the 3-minute chart with its own 100 moving average. So it's the 3-minute 100 moving average that's now showing you a new resistance information, and that same resistance information is being demonstrated on a 1-minute chart, the 200 moving average. So when you're looking for more information to know if we're going to clear a resistance level or a support level, and right now we're concerned about the moving average, particularly the 200 moving average, are we going to clear it? Then you really want to take your cue from when is the 3-minute likely to get through its moving averages. And from that point, you will see 430, here we start to cross the 50 moving average. Up until that point, the 13 wasn't even close to crossing the 50 moving average. So from 430, here we start to cross the 200. From that point, we can say we're starting to clear its resistance level. So you want to pay attention to your moving averages across all time frames. And it's particularly helpful in scenarios like this. Let me see here. Let's see at 11:35. Take out 11:35. No, we still, this is a massive trend, so we're holding up on the pivot. Just see here. Yep, still massive. Let's go to the 7 o'clock. Let's go 7 o'clock in the morning. This is a good example. Okay, this is where it can get really confusing for people. Okay, if you look at the 7 o'clock window, and we do this, let's look at the 7 o'clock window. You're not sure whether the market's coming down really or it's going up. You see that we're in a direction change. We just crossed the 50, okay, and we're going towards the 200. But you went up, we hit the red pivot, the concrete ceiling, and then we started coming down in this window. If we look at our 15-minute chart, by looking at wanting to know how far the trend's going to go, it starts to become a lot more clearer. Because here you are trying to figure out how high is it going to go. Is it likely to stop on that red pivot? Well, I'll tell you right now, absolutely, because 13 is too far from the red pivot. But additionally, if we're looking at higher time frame moving averages for support and resistance information, we know that we're approaching the 100 moving average on the 15-minute chart. And at that point, now we have the 100 moving average, we have the fractal, and we have the pivot. So we have 3 resistance levels to pay attention to. Chances are this market is, the run-up is now over. All the earlier time we were crossing. So let's look at the when we're running up to now when the party is over. So as you can see, the market is just stair-stepping higher at this particular point. We had a little hiccup on the 50 at 5:30. Here's our 50 moving average. Here's a little hiccup here. Okay, we got the previous close, which is the black line, plus the 50 SMA. So can you see that your price section is going to react? It's going to come up and down, is going to react to the same levels as your higher time frame moving averages. So you want to pay attention to those to see where price action is going to change in you, especially if you're scalping and you are a short-term trader. If you're a long-term trader and you're going for the run, then you don't mind a little bit of whipsaw as the market stair steps, because you're trading from this pivot to this pivot. However, if you are a scalper and you get in on the high of something and you're not paying attention to this, you're going to get whipsawed and probably stopped out if you have a tight stop. So the timing of your particular clear trade or gap trade is very, very important, paying attention to those other time frames in terms of support resistance, paying attention to the bounces of the moving averages off across all time frames. And I like to use the 15.5 and 1 or the 15.3 and 1. Those are my favorite time frames to get a nice cross view of where the support and resistance levels are, where the price is going to change on me, and when the price is going to penetrate and go to the next level. So if I go back to so here you can see on the 3-minute chart, I'll just do it like this so you can see this, where the price changes. So here we have the price changing changing on us, and here we have the price changing on us. So up until those changes, you would really be doing trend trades, going long, bouncing off the 13. Okay, you'd be doing your clear trade strategy, and on the changes, you will be doing your counter trend strategy, looking for the circle at the top, the Linreg V, the Linreg 4 to give you a nice sharp V, and making sure you enter off the bounce of the pivot or a fractal, making sure you have 5 ticks or more before you hit the 13. So those changes are more clear to see when you see where other moving averages are sitting on other time frames. So this view is a very nice view of the market, the 3, 5, and 1. Is there anybody have any questions before I move on to the next point? I think we've pretty much covered all that we need to know in terms of moving averages and pivots. The next thing that I really want to get into now is HMA and the fractals. These are very, very important in terms of timing. These two indicators are going to change your world in terms of timing, the HMA color change indicator and fractals. So now that you kind of have an overview of moving averages and pivots, let's move on to the number 6. So before you enter your clear trade or your gap trade, you always want to make sure that you look at the candle position in relation to the direction of the HMA color change and the Reg 9 indicators before entering a direction. Ask yourself, are you north or south of the line, and make sure that you have enough space before you hit the next barrier to get your ticks. So let's take a look at that. And I have a nice little trick. You can start out using, if you're just starting with us, remember you're going to watch those videos over the weekend, and I suggest that you start with the templates, the Mel Basic chart. It's called the Mel Basic. And if you start with Mel Basic, all you then do is you right-click on the chart and you add the HMA color change indicator. It's called the HMA color change. You can play with the plot and the size of it if you like, but it's a basic HMA color change. And you just go in here and if you don't know how to add indicators, go to your FAQ section and watch Getting Started. Watch the Getting Started video and add indicators. Very, very simple. Also, the indicators are covered in your section 7. You can just go straight there and that'll take care of it. So here's the thing that you can additionally, if you, for the purpose of this exercise, I'm going to change my template to a more simple chart, and you can take things off and add things on. And I've got a chart that I call the Naked HMA, meaning I've taken off lots of things, and the one thing I want to stand out is my HMA color change and my LinReg 9. So for this demonstration, I'm going to demonstrate this particular point. Remember, we want to look at the candle position in relation to the direction of the HMA and the LinReg 9 before entering. And we want to ask ourselves, are we north of the border or are we south of the border? So here's an example. You're going along, and you want to know when it's time to do your counter trend. Suddenly you see a green candle appear. Are you north of the border or south of the border at this particular point when that green candle first appeared? So the fact that you are south of the HMA, the red line, means you're going to get whipsawed. There's too many fishies swimming downstream at that point. Only once the candle becomes north of that HMA, and additionally the HMA should start to change color by then, are you safe to take your trade. The same with the LinRegs. Let me do one thing. I'm going to add the EMA for you for a second. Please repeat. You're losing me. Okay, 1 second. I'm going to repeat that. I'm going to do this. I'm going to show you this. I'm going to make this EMA dark green. Let me make it chartreuse so it really is. Okay, so the chartreuse color is the 13 EMA. Okay. This is important because you want to see what's a counter trend and what's a trend. So all the candles that bounce off the 13 EMA are trends. These are your trend trade entries, okay? All the candles that are going towards the 13 EMA are your counter trend. But you never want to go towards 13 EMA unless you're really sure the counter trend is ready to go. So where you start running into problems is this, on these candles here. This is where you start running into problems. When you see the first red candle and it goes green. Why is this candle a problem? Because it's on the wrong side of your HMA indicator. It's on the wrong side of your HMA to go short. The candle needs to be on the south side. Now, if the time it gets on the south side, it's too close to your 13, well, then that's not a worthwhile counter trend to trade because the counter trend is too close. You're not going to get you a 3 ticks inside of a 5-tick window. But now you see the pivot, you got your asterisks. You wouldn't be entering here. You would wait till the candle is on the south side of the HMA and you have enough spread to get your ticks. Now you have yourself a good counter trend. Okay, same with not so much with the trend. You'll see here prices going through, and you've got the 13 right there. You've got yourself a good trend trade. But where it becomes a problem is on trends. Let me show you this. If you apply this for counter trends and trends, you'll start to see things a little bit more clearly. See, I like, especially on direction changes, I like to wait to see when I see my HMA is crossing my 13 and my candle, the body of the candle is starting to push through that HMA, then I know I'm in a good position to start getting in on the trend. Same here, you can see short, your HMA is crossing your 13, the candles are pushing through south of that HMA, then you know you have a good opportunity to go short. But where you start running into problems is this kind of scenario. Now this is a 3-minute chart, so let me do this. Oh, here's a good example here. Notice over here, your candle is below. It looks like they're ready to bounce and take off the 13, but they are below the HMA and the Linreg 9. Can you see that your Linreg 9 and your HMA are now acting as a resistance? They're acting as resistance. It's a ceiling. The candle hasn't cleared on the other side. So I want you to look at your linear regression, your Linreg 9, not your Linreg 4, because that's a fast-moving Linreg. Just your Linreg 9 and your HMA as a resistance and support information, not just as a trend line. I want you to treat them as resistance and support. So if you're trying to go long and you see that your candle is going into the Linreg 9 and it's not on the other side of it, most of the body hasn't cleared through the other side, then you are not ready to trade. You're only ready to trade when you see that most of the body is cleared through to the other side. Then you're ready to trade. Okay? You are not ready to trade if it hasn't cleared. Is that clear? Well, the R3 doesn't really make a difference at this point because it's a wooden floor. It's just a case of the trend was not ready to go, and that the short-term trend line information is telling you. It's not ready to go till the body of the candle is pierced through. And notice at that point, if you pay attention, you will also see that the Linreg 9 is crossing the HMA. Look, I'll make this really fat. Can you see that the orange dashed line is crossing your HMA? Do you see that the orange dashed line is south of the HMA? Here it's crossing north of the HMA. These are very good clues to help you with your timing. Can you see that here you can use the Linreg 9 crossing your HMA to fine-tune your timing? You can say, well, I'm not going to enter until I see a cross. I'll enter on this bar or this bar, and I'll go grab my ticks. And then I'll enter here if I make sure I get it before I hit the 13, get my 5 ticks. So here you've your classic trend trade strategy and your classic counter trend strategy. Is that clear? The practice action has to bore a hole in those resistance before it can make it through to go higher. Exactly. The 2-tick rule does not apply to the HMA. Yes, the 2-tick rule does not apply to the HMA. Just as long as you see majority of the body starting to go through, you can enter. I would even wait till the next bar. Remember, you are set to enter touching candle the very next bar. So you can always enter on the next bar. Could you repeat that, please? Crossing the HMA up or down? Yes. I want you guys to really get this. Let me do this. Just so we see lots more crosses, I'm going to change it to a 1-minute chart. Because on a 1-minute chart, you're going to see lots of ups and downs compared to a 3-minute chart. Would you use a 5-minute chart for crude oil? Yes, I would use a 5-minute chart for crude oil. The thing about crude oil that's very dangerous is that it's a trendy market. So you really only, you're tempted to get in on the trend. The problem is that the bars will whipsaw on you. See if I can give you some. Okay, here's a good example for you. Okay, so here you can see we started to do a gap trade. Okay, we were going up, now the candles are going red. So we actually cleared the sell side of the HMA. If I make the HMA indicator really fat for you, just to make it stand out, to prove this point. Here, let's make it 8. Probably be too fat, but anyways, I want you really to get this, because this is such a simple detail that can change your life in terms of drawdown. Now, you can see how fat the HMA is, right? Nice big fat line. Now look at this candle. Is it south of the HMA or is it north? It's south, right? So if we're going south of the HMA towards the 13, we're in a counter trend. If we're going north of the HMA away from the 13, we're in a trend. It's that simple. So all the candles that are bouncing up off the 13 on the north side of the HMA are trend candles, and all the candles that are coming towards the 13 are south candles. Now, where we get the problem is trying to time our entry if we're not already in a trade. So here you see the counter trend. You know that a trend is starting, and you're tempted to get in here. Now, you wouldn't because you're right on a pivot. You're on the concrete floor. So you have to wait for the 13 to cross. However, if you look at that, one rule you can apply is that the candle is not really north of the HMA. We're coming from the south point, but we haven't really cleared, and it's kind of fuzzy area. It's a real gray area on the pivot there. So what you want to wait for is for the candle to really look like it's going north of the HMA. Look at your linear reg has crossed it, and notice now that your 13 EMA has crossed your concrete floor. That is the time to enter the trade to avoid being whipsawed or faked out in the market. Because I'll show you, I'll find one where it does actually fake you out, like here. If you don't obey the rules for support and resistance when it comes to pivots, especially concrete floors, here's a nice one. This is a nice fake out. Talk about an HFT. And look, even your MACD and your Stows confirmed it for you. They said go long. We're going long. Everybody said go long. HMA is green. Everybody, we're even on the north side. However, what's the rule? When it comes to pivots, you must always, require the 13 EMA to cross it before penetration will hold true. And the PP is the red pivot. So at this particular point, has the 13 EMA crossed it? No. It's a classic fake out. It's a nice HFT move. Bang, you just got stopped out. So if you combine the crossing plus now we're north, now we know we're ready to rock and roll and move on through in the uptrend. Instead, what you could be doing is looking for a nice counter trend. This would be a time to do your counter trend. The circle with the dot appeared, long wick or tail has appeared, 5 or more ticks in divergence, and Linreg 4 makes a sharp V. So in that particular case, you're now treating the pivot as resistance, not as support, as resistance, and you're looking for your nice counter trend opportunity. Also, notice that your candles are south of the HMA. They're south of the HMA, you're looking to do a nice reversal trade. Does the HMA count as one of the 3 moving averages? No, it is a moving average. It's called a whole moving average, so it's a type of moving average. However, it's not the same average as the EMA and the SMAs. It's not the same moving average calculation. It's a different one. So you'll notice that it really follows the price more. It's not as laggy as the 13 EMA, which is on 13 candles of evolutions. So this is a different average. It's more of a short-term moving average. The EMAs and the SMAs are more of a long-term moving average, and you always have to balance short-term with long-term to get your timing right. You can't just have short-term indicators, and you can't just have long-term indicators, because you'll get your timing off, and you'll suffer a lot of risk. Okay, so if you have a balance of the two and you know how to use them correctly, you can time your entries where you just get in at the right time, you get filled, you get in at the right time, you get filled. That's what you're looking for. You're not looking to stay in trades a long period of time. You're not looking to suffer a lot of risk. And that's what we're trying to do here. How about using an HMA to get out of a trade when you're in? Absolutely. Let's say you got in down here, and here you come up here and suddenly you see the candle go below. Time to get out. Time to take your profits off the table if you haven't already taken them. Okay? Time to get out. So look for the HMA, but really this is what you're looking for first. You're first always asking yourself when you enter, do I have a clear trade in front of me, or do I have a gap trade in front of me? And then check your most important indicator, which should be your HMA. Am I north of the border or am I south of the border? Okay, and then check if your resistance and your support information when it comes to pivots. Now I'll tie this all together so it'll make a lot more sense for you in just a second, but let's do this. I want to quickly, before I run out of time, because I want to show you a couple more things, let's do fractals really quickly. Now, I know I'm giving you an overview. You can revise this in more detail. And next week, I'll be doing some real-time trades for you on replay. So we will revise it. It's just that I wanted to get through so that you can connect the dots. Because if I just pick one thing, then something else will fake you out. You know what I mean? Let's do this, sorry, one. Let's just do this last here. So always ask yourself, am I north or south of the line, and do I have enough space before I hit the next barrier, before you take your trade? Now, the last step here is fractals. When it comes to fractals, the one thing you should know about fractals is this. Fractals do not change their properties when you've penetrated them like pivots. You see, pivots and moving averages change their properties from support to resistance and vice versa when you clear by 2 ticks. When it comes to fractals, they do not change their properties like pivots with regards to support and resistance. If the price action penetrates a fractal, you have to move on to the next fractal. You ignore it. That fractal is now useless to you. You move on to the next one. And if there isn't a fractal, you wait for a fractal to come in. Because fractals, they each have their own job. Okay? And the job is this. We're going to look at this really quickly. The green and the fractals are to be used for your gap trades. The turquoise and the brown fractals are to be used for your trend trade. Very, very simple. Let me do this. Because we've got all 4 colors here. I'm going to do something really quickly, just to make it really clear for you. What is penetration of the fractal? Um, there is no penetration rule of the fractal. You can still use the two-tick rule, but let me explain something to you. I took off two of the fractals so you can see this correlation. You can connect this, make this connection. Everybody, when they first approach fractals, gets all bent out of shape. Okay, because they see a lot of lines and they don't know how to use it. So I'm going to break it down in a real simple way to use fractals. Each fractal has their own job. There's only two pairs of fractals, and all they're showing you is resistance and support. But they're showing it to you in a dynamic fashion, unlike pivots. Pivots are levels in the market. The market has to show up at that level for it to be treated as resistance and support. Fractals follow along so you can navigate your way much better and time your entries. So let's do this. The green and the red fractals are strictly to be used for your gap trade. So you're going up, you do your clear trade off the 13, and now you've done your clear trade, because remember you're entering at 13 and you're exiting somewhere up here. Now you're looking for your next move. So what are you going to use in terms of resistance and support? Now, if there's no pivot up here, what are you going to use to do your gap trade? Because ideally for a gap trade, you need to have something to bounce off. You need a resistance or support level. So if we are here, there's no pivot. The next pivot is the R4. So there's nothing to tell us, unless we have the fractal there, to tell us that we've hit a high in the market. We've hit the ceiling. So when you're looking to do your counter trend, you're looking for the circle with the dot to appear, which represents the green fractal. And if there's been two previous asterisks, the fractal will already be there. The fractal will already be there because there are infinite rays. That's the nice thing about fractals. And what's unique to shadow traders, nobody else has these fractals, they are infinite rays. And so they can tell you, they can give you an element predicting the future, because here you are. When the fractal was drawn back here, you're stair-stepping up, you're coming along, the fractal is still there. Now you see the circle appear, the circle with the dot, you go, we are ready for a counter trend. I now have a counter trend opportunity. So I'm now looking to grab my 3 to 5 ticks in my counter trend. So I'm using the green fractal to do my counter trend. And if we're coming short, and I'm looking for an opportunity to go long, I now have to wait for the bounce of the red fractal. So as you can see, we're crossing, we're not done coming down yet. There's no real gap trade to be done here. So I've got to wait for this market to go lower still to give me that divergence that I need. And as soon as I get it, when it bounces off this fractal or a new fractal, then I know I have a counter trend opportunity to go long. So you're going to use your green fractal and your red fractal for your counter trend strategy, not for your trend strategy. Because the trend, your entries off the 13, your exits at the fractal, or lower still. Your counter trend, your entries off the fractal or a pivot. And if there's no pivot there, you use the fractal. Most of the time, there'll be a pivot in conjunction with the fractal. Now, if we do this, and I put the turquoise fractals there, okay, turquoise fractal, and I remove the other two, And this is the simplest way of looking at fractals. And look, if you're just a counter trend trader, then take the other two fractals off. If you're just a trend trader, then take the other two fractals off if you only want to use two. It'll make your life a little simpler. Okay, so here I am trying to do my trend trade strategy. Remember, for trend trade, you're using the turquoise and the brown fractals to be used to time your trend trade strategy. They're showing you support and resistance for the trends. So, if we look at it like this, here you are ready to do your clear trade strategy, and what you're looking for the touching candle off the 13, right? You can see your Linrex crossing, candles are pushing through your HMA. You got 3 or more moving averages back in the direction, okay? Two more time frames matching, so your 3-minute will be in sync at this point. But what else do you notice? Notice that we are bouncing off a brown fractal. The brown fractal is showing you the confirmation of your low. It's your confirmed low. We hit a floor, so indeed we are bouncing higher. Now we're looking to go trend trade short. Look, our 13 is crossed, so we've started the trend down. And let's say I don't do the counter trend, I'm looking to do a trend short. I'm now using my turquoise fractal, there's my asterisk, to start the trend short. But the brown fractal is not there. Here's the brown fractal. Here's my brown fractal. It's there. It's there from all the way down here, trust me. It's just that the fractals will disappear as price moves. So the historical fractals disappear, but here's the asterisk here. Okay, so your brown fractal is plotted all the way from down here. There's the asterisk. It's just that they start to disappear as the new fractals come in. Now, look, here's the confirmed low that's come in. Notice that we're now changing direction. So over here, we have ourselves a, here's the red fractal. Is not ready to go low yet. So what we're watching for, if you're not showing this direction because you don't have a counter trend and you don't have a trend yet, we don't have the candles pushing below the price yet. It's starting to come in, but notice a circle with a dot. What we're looking for, is there going to be another turquoise fractal? Is the circle with the dot going to come in? Is the price going to go below this HMA? Then I know that we're still continuing down to the red fractal. And if it doesn't, this will change direction and go, and we'll cross and we'll have a reversal. But that's what we're holding, that's what we're watching for. Is it going to go lower down to this 100? And only at that point, somewhere down here, will I get another asterisk of the red fractal, and I will get an opportunity to do a counter trend. So let me just summarize this for you. I'm going to take this back to the original template so you can see it more clearly. There you go. Okay, so remember, we're not interested in the red fractal for anything else other than when the price hits it, do I have a counter trend strategy? Right now, what are we looking to for a trend trade strategy? The indicators we're looking at is our asterisk bouncing off. There's the turquoise fractal just came in. Is it south of the HMA, right? Do we have 3 or more moving averages back in the direction of short? Do we have more than one time frame in sync? So we pull up our 3-minute chart. Is our 3-minute chart confirming that we're going lower? So our 3-minute is red. This is coming down. Asterisk just came in off the turquoise fractal. So the turquoise fractal is helping me to show you we hit a ceiling There's our resistance point. The trend is continuing lower. And I can ignore these red fractals. When it comes to the trend, you're always looking at the outermost fractal, just like Fibonacci numbers, as your ultimate support level or resistance level. You always, when you get multiple rays, you're always looking at the outermost fractal as your true support or resistance. The inner ones, they may bounce, but they go through. So you kind of have to go with your trending information to see. How are those trend trades without 3 moving averages? Without the 3 moving averages, they could turn. They could absolutely flatten out. Now, this is, not the best time to be trading the 6E. You can see we're like fizzling out here. The volume is, lots of dojis are coming in. When you see lots of dojis, then you know there's not a lot of volume at the moment. But when it comes to moving averages, you're basically looking at 2 criteria. You're looking at a reversal criteria or a trend criteria, a counter trend or a trend. Let me find a nice example for you, something that's a little cleaner. Okay, this is a nice one. Remember, if we're going short into the moving averages, that is your classic counter trend, your gap trade. It doesn't have the 3rd moving average back in the direction. It's very important that you understand the difference. Even though there's lots of price action, it will only do that if the trend has hit its ultimate ceiling and it's time to change direction. And you will notice that a second time frame will confirm that. If we go to 6:30 in the morning here, can you see that your 3-minute is also confirming that we've hit the ceiling? So now you've got 2 time frames confirming that indeed we've hit our high. It's time to do the counter trend. But you always have to be cautious when doing counter trends, because as long as you don't have that 3rd moving average back in the direction, on the 1 or the 3, things could always turn around on you. That's what you're concerned about. It can always whipsaw. Only once it crosses that 3rd moving average do things go better. And I even like to still consider it. Notice here, look at the 3-minute chart. Not until do we cross the 3rd moving average on the 3-minute chart does the trend really take shape. You can see it still whipsaws on you, and that's the thing you have to always keep in the back of your mind when you're trading against majority of the moving averages, when you're trading the counter trend. So you got to keep your target short. You want to get in exactly when the circle with the dot or off a pivot, grab your ticks, or at the cross, make sure you're out by the 50 moving average or the 100 moving average, the next barrier, and wait till you see your small moving averages. See, and all this whipsaw, even though there's price action, is because look at moving averages. They're acting as support and resistance. So we're trading between the moving averages. When you have both green and red outer fractals, which one do you follow for the ultimate target if you are trading for a longer term? When you have both green and red fractals. Okay, that's a good question. Which one? Well, I'll tell you, that was my next point I was going to explain to you about fractals. If you want a real secret, a good secret to follow, you want to have your 15-minute chart, and you want to use your medium and short-term, your medium and long-term fractals to help you see where price is likely to go. You don't really want to use your 1-minute fractals to see the long-term trend. You're really using the red and the green to bounce off of, to do counter trends. But what you're using the brown and the turquoise for your trends on the 1-minute chart. But I would tell you to just take the fractal off the 1-minute chart if you're a trend trader and just focus on the HMA and 13. I would get rid of the fractals on the 1-minute chart and just use the 13 EMA, your HMA, for your entry. So you want to make sure your 13's cross, you're trading with most of the moving averages, and you're looking for these crossing and these bouncing opportunities to follow the trend. But here's the tip. Pay attention here. Let's say you come at 10 o'clock in the morning and you see on your 15-minute chart, we just crossed the 100. Chances are we're going higher. Things are looking pretty good for the afternoon. So here you are at 10 o'clock and you're wondering how high you're going to go. 10:30, right? You're at 10:30, you just crossed the 100 on the 15-minute chart and you're wondering how high you're going to go. Well, the answer is very simple. You're going to go to where those fractals are sitting. And you'll notice because they're infinite rays, they plot into the future, you're looking to trade from the entry point to where those fractals are from. So I know at this point that we're likely to go at least to the R2. We may squeeze through and get a new fractal, but we're likely to at least go through the R2. But now notice something. You will notice that when you get this fractal, we come back down and we bounce off the support again here at around 1 o'clock. You will start to see additional information coming with the fractals to tell you how high you're likely to go. And the combination of the moving averages and where the fractal is sitting, I do this all the time. I jump in and I trade from that point to, I know we're going from here all the way at least past the R2. So if you start to look at your support and resistance levels, you start to say, okay, so from around here, 90 and my R2 as at 96.03, you know, I've got over 10 ticks there. And you start looking to trade, and if you're following your fractals and your circle with the dot information on the medium term as well, it will help you to narrow it down even further. Is that clear? So use your medium term, like your 3 and your 5-minute fractals, to give you those infinite rays to show you, here you're at the starting point, you'll start to see when these fractals come in. And if everything is still green, don't get out of the trade. Stay there. If you see we're likely to go up to the highest fractal, the outermost fractals are the ones where we're likely to go to. You watch your 15-minute chart. It will give you those fractals ahead of time. You will see the infinite rays already plotted there for you. And that'll tell you if things are in an uptrend, that's where the price action is likely to go. So now fractals I usually spend a whole class on, and I'll show you lots of examples, but I really want you to get, let me see, I just want to check the ES for a second, because the ES moves in the afternoon. Starts to move from 2 o'clock. So I'm going to, because the 60 kind of peters out, I'm going to switch this to the ES for a second. It's a little choppy. Crude oil is going higher to 110. I know, $110 a barrel. That's just crazy. I remember a few years back when we broke 100 and we all just about fell off our chairs. Okay, so you will start to see when the trend starts, you will start to see with these fractals, you see from this point, from 6 o'clock in the morning, these fractals are already drawn. And when you're coming in, you know that you're going, you're gonna go higher to those fractals. And if you see the R4, chances are you're most definitely going to be going to the R4. One thing I do want to tell you that I didn't mention with relation to the pivots. When it comes to the R4, and the S4, the ceiling and the floor. Let me see if I can do this. Let me do it on a 3-minute chart. It's a little easier to explain. The one thing you want to watch for is if you see that the price action has crossed the R3 or the S3, then the probability factor of it going to the R4 is very high. Once the 13 EMA crosses the S3, let me see if I can find the S3 for you. Here's a nice one. Once you see that the pivot crossed the S3, chances of it going to the S4, the probability factor is very, very high. But you must wait for the 13 to cross the S3. So when it's like, it's especially more so going up than down. If the 13 crosses the R3, then you know what, then you should just have dollar signs in your eyes. You should literally just hit buy. Whenever I see 13 cross the R3, that's it. And I see the confirmation of my higher time frame. When I see this, then I know there's only one place we're going, and that's the R4. There's only one place we're going, and that's the R4. So never miss those opportunities. If you happen to be there, and a lot of times, you know, they're very nice runs. Like on the ES, we're at 80, 79, and here we're at 83. So we ran up almost 4 points. Okay, and on some markets you can run up 20, 30 ticks, sometimes 40 ticks. I've seen that spread. It's a lot of ticks. So don't miss that opportunity. You should, and most of the time it goes right through the R4 because the market loves to go, when it's going up, it likes to go higher. So let's just wrap it up here and conclude the main points we covered today. Remember, when you're looking at support and resistance information, what are you really looking for? You're looking at places to grab opportunities, to grab either a trend trade or a gap trade. That's essentially the information you're looking for. So it's very important to know the direction and to see if there's a criteria for you to execute these two strategies. And one of the most important thing that we look for is when it comes to penetration, there we have a 2-tick rule. The candle has to penetrate by 2 ticks from the lowest point or the highest point of the candle. So if you're going long, it needs to be from the lowest point, wick or body, and for going short, it needs to be from the highest point. The only exception to this rule is if you're actually entering your trend trade and you need to enter on the touching candle. So that's the only time you will enter, but you want to make sure that your 13 EMA has indeed crossed your 20 SMA in the direction. When it comes to pivot, you want to make sure that you are following, that your 13 EMA crosses your PP and your S3 and your S4, your concrete floors versus your wooden floors. Remember, your wooden floors, you can ignore the pivots if you're in a trend as long as there's momentum. Let me just move this out so you can see it. You can ignore the pivots. You can see you don't have to wait for the 13 to cross it as long as there's momentum if you're on the trend. The 2-tick rule also applies to all the moving averages. As you can see here, in short, we never penetrated the 50 SMA to come short, so therefore the SMA is actually support. This SMA, the 50 SMA, is actually support. So the 2-tick rule applies to the other moving averages as well, especially the 200, which is your strongest. Pay attention to the balances of the moving averages across all time frames. Penetrate or clear. Well, they're one and the same thing. In terms of terminology, when we say penetrate, we talk about clearing. It must clear the fence by 2 ticks. If we look at this 9.5 here, can you see that the reason we're bouncing off support at 9:45 is that we just had a gap trade on the 15-minute chart, and the 13 moving average is now support. So pay attention to other moving averages across all time frames, because they also contribute to support and resistance. So you can now see where the trend's going if you just have your 15-minute and your 1-minute or your 3-minute up, just based on that support information of that 13 moving average. It's telling you. So now you're looking for, is my candle above my HMA? Is it time for me to get in? Is it green? Am I ready to enter? You wouldn't enter on the red candle. You wouldn't park your order here because it could go lower first. You wait for it to go green, wait for it to go above your HMA, then you take the trade. The 15-minute just confirmed it. So look at the position of the candle in relation to the HMA before you enter. Ask yourself, am I north or am I south of the HMA? Notice on this candle, where majority of this candle coming short, we're actually on the inside of the HMA. We're above the HMA. So coming short, I wouldn't be taking that candle to come short. Okay, and lastly here, fractals do not change their properties with regards to support and resistance. The green and the red they always have the same jobs. So the green and the red you use for your gap trade, and the turquoise and the brown you use for your trend trade. So you wouldn't be doing a trend trade off the green here. You would be using the brown. Here's your touching candle. Here's your brown fractal to do your trend trade long. Now what you're doing is you're waiting for enough divergence before you hit the 13. So wait for this to go up a bit. Then you'll get a circle with a dot for your green to come short. Wait for your candle to go below your HMA. You'll get the circle with a dot off the green fractal. Then you'll have yourself a counter trend. So the brown is for trend, same with the turquoise, and the red and the green are for gap trades. Let's see if we can see it here. See here on the 1-minute chart, if I do this, even though we are on top of the 13 already, but the 1-minute chart is going to give us a circle with a dot off the green fractal, and we're going to be doing a counter trend to come back down off the green fractal. But we wouldn't be trading here. Why? Because we're on the 200. So we're going to wait for all of this to clear the 200 before we even look for a criteria. And at the end of the day, we're looking for a good gap trade opportunity or a good clear trade opportunity. So I hope that was clear. Is there any last minute questions that I can take up for you before we end off? Anybody have any random questions or how to do this or that? Feel free to type those in real quick and I can take those up for you. Or you can also email me at melaniesuntrades@gmail.com, which I'll type in again in case you didn't get it earlier. melaniesuntrades. Now, I know today was a lot of information, so next week I'm going to be doing some replays for you. And I'm going to be revising this and tying the last 4 weeks together. So don't miss next week, because next week is going to be a tie all together class. I'm going to be tying the HMA rule. I'm going to be revising the rules for the support and resistance, and we're going to make some trades together. We're going to be using the fractals, short-term trend lines. We're going to be using the higher time frame, and we're going to remember we're going to be still following the principles of the balanced trader that we covered last week. Last week's were amazing. It's putting together some of those loose ends. Excellent, Vicky. You'll be surprised how, the stickler is always in the details, these little nuances. If you don't know, if you forget some of these basic rules, like the 2-tick rule, especially in relation to the 200, how many of you have entered a candle like this on the 200? You come along and you forget the 200 rule. You only see the clear trade. It's like you don't even see the 200. and you forget. We've all made that mistake. And then it doesn't go anywhere and you wonder why. Remember, it's these simple rules that you can follow. Remember? Never enter a candle on the 200 SMA unless you confirm the 13 EMA is crossing it. Very, very, very important. And make sure that your higher time frame is confirming it as well. Any news on the Auto Trader? The Auto Trader is not released yet, guys. It's going to be a while. The summary sheets are awesome. Yes, if you want a copy of these sheets that I typed up, then I'll send them to you. But these are, you know, once you've been through the self-paced course, remember there's information that is nice to know, and then there's key points that you must know and you must stick to all the time if you want to be consistent. So even throughout our course, we give you lots of information because different people come in at different levels, so we give you the A to Z, but there are certain nuances that stand out that you must follow every single day with every trade. Otherwise, you will get caught. You will get whipsawed in the market. And these are some of the basic rules. The 2-tick rule is the most important rule. The 200 rule is the most important rule. Understanding what to do with your red and green fractals versus your brown and turquoise fractals. Knowing what strategy you're executing when you're executing it. Very, very important. And understanding your pivots. You're missing golden opportunities by not knowing that the market's going to run to the R4 when it crosses the R3. You're missing opportunities about running to the S4. You're also missing counter trend opportunities if you don't know about the S3 pivot rule. Here's a concrete floor. Here's your S3. You've got to know that if you see that the market is hanging tight there, and if you look at your higher time frame, you go to 5:45 in the morning there. Look at 5:45 in the morning on the is that the right day? 17? Oh, this is 18. We'll go back one day. Yeah. Look at that. Look how far the 13 is from the pivot. See how far it is? So chances are it's going to stop on that the pivots there, and price action, look at the price action, is now north of the HMA, turning around. So you're missing that wonderful counter trend opportunity if you don't know the functions of these pivots and what they're really telling you in terms of information. So now you would say, oh, look, my 15 minutes, 13 never made it close enough. It's too far away from that pivot. We're not going to be going lower to the S4 today. I'm going to watch for these candles to go above the SMA, and I have myself a nice counter trend opportunity, and you go for the ride. Excellent. Jill says, I made 2 successful trades today during class based on what you said. Do you find that the moving averages as barriers on the very high time frames are stronger but less precise? Yes. Well, you see, the problem with the higher time frames is while I can show you here, I can show you a 60-minute chart, for instance. Let's do 40. I like a lot of professional traders use a 240-minute or a I like to use a 120-minute chart. And the other nice thing is you'll see fractals coming on your higher time frames as well. You want to pay attention to those fractals, especially if you're a trend trader or a long-term trader. But if we look at yesterday at 5:30, you can see here we were on a counter trend, right? And notice that the candle at this particular point here, we're on the inside of the HMA, and we're on a support fractal. Notice that we've got our red fractal, but mostly we've got the support fractal. We've got the brown fractal, which is our trend trade to go long. So here we're starting with our trend trade to go long. So price, look at the long tail here. Price wasn't able to sustain. And so when looking at the higher time frames, you use the moving averages along with fractals giving you support and resistance. And I'll tell you right now, these are really good tools to use in terms of where price is going to. Where's the price going to? Well, hello, it's going to the fractal. And notice that the fractal is already there. So use these higher time frames to give you that information. There's your fractal. There's your infinite ray. Where's the price going to? It's going to that green fractal. Once you get there, then you have yourself a counter trend opportunity. You're counter trending, you're doing your gap trades off your green fractal. So once you hit that, then you got your counter trend opportunity coming in. Okay? So you can use this information, these rules apply across the board on the time frame. Look at a 120-minute chart. It shows you also very, very nicely. There's your nice maroon fractal coming in. We're going long, going straight to that green fractal. Do you find the moving averages is better? Okay, answer that question. Is the quant trading class going from 5 days to 2 days? No, the class is every Wednesday, 7:30 Eastern Standard Time is the quant trading class, the Segredo. But I think the trade room, I think they're switching guys. So right now, I think they have the trade room on Tuesdays and Thursdays. I think they just made the adjustment this week, or from next week. Sorry, next week. They're going Tuesdays and Thursdays. But yeah, they have some other people in training, and they're going to be bringing different guys in for different markets. So hold out for that for right now. But the current guy that's trading from the CBOT, he's going to be doing Tuesdays and Thursdays. That's correct. For the trading room in the mornings. Excellent. Well, I'm glad you guys seem to get a lot out of today. What kind of success is the quant room having? That I can't tell you. I'm not really monitoring those statistics, but I know that he's doing a lot of good trades. So you want to check it out. If you are a Segredo subscriber, it's free. Just click the announcement tab on the Segredo page, and he'll explain how you'll be able to access the room. There is no class tonight? No, this is it. You have to either record it and watch it later, or come next week and I'll see you at the same time, 12:30 to 2:30. Now next week I will be tying it all together and we'll be doing some trades, and we'll be, as we're doing the trades, we'll be walking through the rules that we should know, right? That we should have memorized so that we never forget these rules and we never forget the criteria, the basic strategy. And so between now and next week, I want you guys to practice on the replay and go watch those videos in your self-paced course and go through section 7 at the very least, because those cover some of the indicators, like the HMA. But you want to go through the gap trade videos and the clear trade videos, and then go practice on the replay. You like this time much better? Yes, I like this time much better too. Yes, at least now I get some sleep, so I don't have to do it at 3 in the morning when I'm, I got half a brain going. At least I have a little bit more brain function happening in the daytime. So thank you guys for listening. Thank you for time, for attending. What time is it now? For me, we're 5 hours ahead, so it's 2:30, 3, 4, 5, 6, 7. So it's 7:30 here. It's summertime, so it's still daylight outside. It looks like about 4:30, but it's actually 7:30. So I'll be grabbing some dinner and watching some telly, and then I'll be going off to bed, and then I'll start trading first thing tomorrow morning. So guys, I wish you the best. Tomorrow should be a good day for you. Thank goodness this Bernanke is over with. But remember, we are approaching the summer doldrums, so make sure, trading lighter and lighter. I have noticed it's gotten a lot lighter this week, even compared to last week. Last week there were lots of great runs. But the beginning of the week was good, but now it's really lightened up. A lot to do with Bernanke this week, but let's see. But make sure that you really stick to the criteria. You must only look for your clear trade, your gap trade, and your reversal trades, and you must adhere to these rules. Okay, so I will see you guys next week. And if you want the PDFs, just email me at melaniesuntrades@gmail.com and I will send them off to you. Thank you guys for listening, and I wish you happy trading. Ciao for now.
The organizer has ended the session, and this call will be disconnected. Goodbye.